Welcome to the Broken Pie Chart Podcast, episode 359. I'm your host, Derek Moore. Back again with me is Mike Snyder and Shane Skinner. Jay apparently got lost to the podcast studio, so if he'll be back maybe at some point. All right. So we did our prediction show last week. It was interesting to hear some of the feedback. Like, people like the disparity of opinions or the variety of opinions, certainly. And I'll remind people, if you haven't listened to it, listen to it. Don't trade off it. It's really for fun. But what struck people was, I think how similar we were on some stuff, but how far apart we were on other things. So it's always interesting to hear the feedback from that. I don't know. I don't really want to talk any more predictions, but I do want to get into some of the market stuff. Why don't we start here? Shane, you had seen, was it Mohammed El Alarian, formerly of PIMCO? I always thought he might be a good Fed chair, to be honest with you. I thought he would be.
I agree. I love a lot of the stuff he puts out, and he's been awesome to listen to over the years. I think he's very knowledgeable.
I think my book agent, my literary agent, was his editor on one of the books. I remember. I think she was telling me she worked with him on a book. And all right, but anyway, so he came out and he said, "Look, I don't think anything is going to get done by the Fed before Powell leaves. We know his term's up in May." Shane, I went, after you mentioned that, I looked at the probabilities for interest rate cuts. And no cuts are forecasted on a probabilistic probability basis, right, if I can say that, until the June 17th meeting, which would be the first one after Powell. Assuming that's the way it goes, there would be a second cut by December. It's only 2 cuts. So I don't know. I mean, Shane, I don't believe it's changed that much, but is this a big deal? Like, I feel like if the markets are still like, oh, we're getting cuts, it's almost like that's better than we cut and we're done.
Yeah, it's almost like the banana on the string, hanging out in front of the market, if you will. I did predict that I think we're not going to get a cut, at least under Powell. We might get 2 after. It looks like the market thinks that happens by the end of 2026, with 2 being estimated by December 9th, it looks like. I think the market likes the idea of them being out there still. And I mean, based on the movement today, and whether it has anything to do with this or not, I mean, the jobs number today wasn't bad. It could have been better, but it could have been much worse. So between that and inflation not seeming to be getting out of hand, why do you, or Mike, I mean, what would make you guys think Powell would cut with this kind of data coming out? When he's been so adamant that it is a combination of the job market and tampering inflation that they're sort of focused on here. I don't think he's going to ease into what we perceive as good data already.
Mike, like, what if you're Powell? And I don't know why you're not being considered for the Federal Reserve, but that's a separate conversation. But like, Mike, if you're Powell, like, what are you worried about as far as legacy? Like, if he raises, if he cuts, like, does it really matter? Like, why wouldn't he raise? Is he worried that if he does it and then inflation comes back, they'll blame him? Like, what do you think he wants to accomplish in the last 5 months?
I mean, I think the writing's sort of on the wall here. And I don't know, like, he might be thinking people are going to cut when he leaves. And so, if he doesn't really feel the need to or see the data that supports more cuts now, then I don't think he's going to do it early just based on someone else's agenda. I think it's been pretty clear that whoever is put in is going to, want to lower rates based on, the current administration's agenda. And so, he knows he's got a finite amount of time left, and I think he's also, fairly straightforward in how he speaks and sort of tells it like it is. So if he doesn't see a need to cut, I don't think he's going to do it just to cut.
I mean, does he? All right, that's fair enough, Mike. Like but what is he worried about? Like, do you think
is he worried?
Well, I don't think he's worried about anything. I think he just maybe is going to say, well, there's no data on a cut. I mean, I don't know.
I think there's concerns about the back end potentially, but I also think his philosophy is if we can run at higher rates, we should. And I don't think, we'll find out if he's right or wrong years from now, I guess. I don't know. But don't you guys think that if we have the ability to operate at higher rates that we should while we can? Or
I go back. No, I mean, I don't disagree. Like back in the 90s, now imagine this. In a money market fund, you were basically getting like 5%, 5.5%. And back then too, banks tended to give you a better rate. Like now in a normal run-of-the-mill checking account, what do you get? Like 0.01% or something crazy like that?
Yeah, unless you put it into something that's actually...
No, like the Goldilocks is that the economy is growing and you don't need low rates. And by the way, we didn't have that much growth from 2009 through, when did we first raise? Was it 15? No, it was 18. Wasn't it 18? They didn't raise until? So I don't know. I will tell you though, there's something that I believe they're going to do, and Trump has signaled this. CNBC article says President Trump on Thursday said he's instructing my representatives to buy, and I assume that's the Fed or the Treasury, to buy $200 billion in mortgage bonds, claiming that doing so will drive rates and monthly payments down. So this is specific to the housing market because we know that long bonds, specifically the 10-year Treasury, has a very good correlation with 30-year, and we talked about the spread between those. But I almost wondered, like, Mike, they may not even need to lower rates, but just getting the long end down. And I suppose you don't want to invert the curve, so maybe you do lower the front end. But Mike, I mean, that's what people want. Like, I don't think people are too concerned about like, oh, my short-term financing, if I do a bridge loan for 30 days, like people want to know when mortgage rates are coming down, right?
Yeah, that's what I was going to point to as a reason why I think, there's a theme that we want lower rates. It's because housing, there's a story that housing has become unaffordable based on current prices. And then you combine that with interest rates. There's a theme out there that housing's is not as affordable as it once was. So I think getting mortgage rates down, and like you said, that doesn't necessarily mean the Fed has to cut, but getting mortgage rates down, which this I think is supposed to accomplish, would help take care of that.
At some point, I have to do some real, spend some time and do some real analytics on this, because I always hear that housing has never been as unaffordable as it is right now.
I have no data to back that up, but that's certainly a theme out there.
Oh, I'm not saying you're wrong. I'm just saying I want to find out, because I feel like the average square foot of a house is bigger now than it was back in the 70s, back in the 60s. And then, I mean, really, it's the interest rate. So, of course, with lower rates, your payment goes down. I mean, it's significant, but I don't know. Like, I just feel like, I look at a price in, let's say, 1965. And why 1965? Because it's on my screen and I can, kind of. So if we say the median home price is now $410,000. See, this is the problem with, I get these ideas and then I want to do this live. So 410,000, call it, divided by 19,800. So that's what, 1,970%. But that is over how many years? That's over what? 35, that's like 60 years. So, I mean,
Go ahead.
I mean, let me do the math. I'll kind of figure out what the annual increase is, but
So I mean, I just sent you guys this. Sorry, it's not on the docket ahead of time, but spur of the moment here. National Association of Realtors came out with this earlier last year. The median age of U.S. home buyers since 1981. In 81, it was 29. Never got below that other than 28, it looks like, in the early 90s. And then since then, it basically ran sideways from about 30 to 32 from 1990s all the way up until 2018, it looks like there. And then we hit 33. And from there, since about 2020, the average age has gone from 33 to 40 for first-time home buyers. So I don't know if that's because people that are younger than 40 can't afford it as much. That could just be lifestyle choices. It also could be the appreciation of real estate over that same period of time, rising interest rates since 2020, right? It's a lot easier to probably buy a home with a rate below 3.5% than it is at 5, 6, 7.
I mean, okay. I mean, this is something I actually want to spend time on, and maybe I'll write an article about it and we'll put it on our site. But I mean, there's definitely some factors. And I think it's easy to say, well, if you do 10% down payment or 20% down payment on median price of a house, if you're buying the median house, it's like 80 grand, where in 1965, it was, what did I say? It was like 19,400 or 20,000, whatever it was. So yeah, it's like $4 grand, but then it's all relative. So am I right here? It's like 5% annualized growth in what did I say, 60 years?
Yeah, that looks about right. The other thing, I don't know if you guys saw or heard, they're talking about the Fannie Freddie thing, right? And what's going to go on there. This is a really, really big deal. But they insist that they want to keep housing prices stable and high. They don't want housing prices to fall. They attribute that to many people who own houses in America that's tied to their net worth. It's tied to loans. It's tied to a multitude of things elsewhere in the financial system, if you will. But I just find it interesting that the goal is to not necessarily bring down the value of homes, which you would think increasing the supply would do, but more so make them more affordable. So could we see sort of a unification across this industry where, new homes get built, the supply does increase, but we don't see this major underselling of one another amongst competitors within that space to sell these houses for cheaper than what most cost now. Does that make sense?
All right. We'll have to dig into that more. Yeah. You lost me a little bit, but that's okay. It's not the first time. All right. Let's move on from this. But I do want to spend some time on this because, by our numbers from 1965 to now, the median home price, I think if our numbers, I did this on the fly, it's gone up about 5% annualized. Is that crazy? I mean, is that
no?
Think about it. If you bought that house, the median house in 1965, and then you had the median house today. I know it's a crazy example. You're like, well, that didn't really work out. And that's not even after inflation. So after inflation, really, you're just growing about 2% there. So stocks have gone up way more than that since 1965. All right, let's move on from this. But I think the house is bigger too. I'll bet you the
average house size, square footage.
Yeah, the median.
Yeah, I agree.
The median home price is one thing, but the median per square foot is another thing. And I'd have to try and see where you can get that data. All right, let's move on though. Where are we going next? All right, S&P earnings per share growth estimates year over year. This is from Bloomberg, KKR Global Macro and Asset Allocation Analysis. All right, they fooled us. They fooled me here. This is actually only from September 30th, so these may change. But the point was that sure, the Mag 7 plus tech have the highest estimated by the analyst year-over-year growth for, this is an old chart. Why did somebody post this on Twitter? All right, anyway, the point was that like the other stuff, if they come in based upon what analysts are saying, X the Mag 7 and tech, you'd have some of the better growth rates, just going back to 2022. I guess it's just what we've been saying all along, that it's not just tech. It's not just the Mag 7. We're seeing a broadening out of that. All right, that's an old chart. That's on me. Throw a flag on me for bringing that in. Didn't pay attention. Sam Rowe had posted something on his TKER letter. S&P 500 revenue per worker jumped to record highs after 15 years of stalling out. So you guys can see the chart there. And this is from US Equity and Quant Strategy / FactSet. And basically what you see is this starts in 86. So PCs come in and you see this jump in sort of revenue per worker. Internet browser in 94, you get this other surge. Mobile data, cloud services, and then you look at big data, AI, and automation. Mike, I mean, if you look at this, is this like this surge in, I don't know, revenue per worker? Do you think it's tied to AI, or do you think it's tied to a lot of the big companies, the tech companies specifically, or like we've hired way too many people? And like Meta comes to mind, where they cut workers and got a little bit more lean. Like, I don't know if I'm buying this chart yet.
You're not buying that it's AI driven?
Well, I'm not. And I'm also thinking companies cut, especially tech, but also the types of companies. Like Instagram doesn't trade on its own. It's part of Meta. But I'll bet you can run Instagram with way less people than you could Exxon and a bunch of plants, right?
Right.
These are different companies.
I mean, I think it can be a combination of both AI and cuts, right? I think AI inevitably should lead likely to cuts, right? Because one person can do a lot more work with, using AI. So I think it could be a combination of not just, a company that all of a sudden uses AI and doesn't let anyone go, that each worker is now generating more revenue, but that they need less employees to generate the same amount of revenue.
All right. No, fair enough. Shane, I want to talk about valuations too. And this is from Truist Wealth. Valuations less extreme when adjusting for structurally higher profit margins. I've seen the different variations of this chart floating around online. And basically what it is, it looks at the forward PE versus the probability adjusted PE. What does that mean? It's got the chart at the bottom, the operating margins. This is from the S&P. And no surprise, I mean, you see these 95 to 04 was 12%, 05 to 14 was 13%, 15 to 25 was 14%. And then, right now, we talk about this on our call internally. It's about 14.5 net profit margin forecast. So I think the reason why I keep seeing this chart pulled up online is that, Shane, are people trying to make the argument that it's okay to have higher valuations because operating margins are higher? I mean, is that kind of what you're reading here?
Yeah, absolutely. And I mean, I think if you were to channel the past from 97, I love that this chart, I think you did this on purpose, right? Since I was born, this is when this chart started.
Not my chart, but Truist knew, and yeah,
Truist,
absolutely.
Yeah, no, but in all seriousness, I mean, this is an upward trending thing. It makes sense as the market trends upward as well over the same time period. And, it's clearly there are periods of growth, there are periods of contraction. And the thing that sticks out to me, maybe you guys can help me call on something out if I'm looking at this wrong, but every time in the past where we've had a steep drop off, looking at like 2023 to 2025, where we bottomed out there and since have lifted off. It seems like once we've committed to a rebound, there's usually some pretty strong increase in operating margin that follows over a couple of years, it looks like, at least historically. That doesn't mean it's guaranteed ahead of us, but it's hard to look at something like this and I think argue against the trend and just sort of the overall forward-looking expectation here about what's going to happen.
Yeah, like if you look at operating margins, you look at when the troughs are, and no surprise, like 02, after 09 into 10. 21 is interesting. And maybe that should have told us something, because coming out of 21 into 22, I mean, that's kind of when the downturn started. We had like just a normal bear market, 22 into 23. So I don't know, like on one hand, this is, how do I give an excuse of why I can still be long with high forward PEs? Like this is sort of trying to justify it.
Right. I'm going to bring this up simply because you do have another data point that sort of ties to this. But, it's almost as if like, do you think when President Biden won the election in 20, or like when he's transitioning is when this drops. So it was Wall Street expecting him to make decisions that hurt the market? I don't know. I mean, the market, like you said, did pull back in 22, but it's interesting because operating margins tighten right around that transition of power. Were there some policies that got put in place at that time that affected operating margins, or was that just, a slowdown overall in economy? I don't know. But
no, I think it was companies got too big and fat, specifically tech. I think they added way too many workers.
Yeah.
And then when net margins or operating margins started to get better, I mean, we remember this. Like Meta was like, okay, we got to stop spending money on the metaverse, and we got to right size our workforce. I think, didn't Microsoft lay off some people, and some of the other tech companies? Google, I think, did it as well. So
I think the banks did as well. I think there was
they may have
the financial sector a little bit. So no, that makes sense too. I buy that.
Mike, so what do you think? 14.5 net profit margins? Is that good for the next decade, every year? Can we book that in? You good with that?
Yeah.
Are we going to 20?
Look, who's to say what the right or wrong forward PE is, right? There's a historical average. It doesn't mean that's where it needs to trade. But at the same time, I mean, operating margin, this flows into what earnings estimates are. So I think it's, like you said, I think it's a sort of an excuse if you think that the market's too expensive relative to where it's traded historically, like to be okay being long at this valuation. But, I think you also have to think that operating margin has to continue to improve if you think the market is, or you're worried about the market being overvalued.
This flies in the other thing I keep hearing is that all these companies are spending so much money. They're burning their free cash flow on CapEx spending and data centers and everything. And then you look at the chart this was from December. There you go. So I'm good. It's a recent chart from Empirical Research Partners. I'm not sure who that is, but I'm sure that's a good group. S&P free cash flow margins, tech and interactive media versus the rest. So I don't know exactly what interactive media, which companies are in that, how they define that, but I assume it's tech related. So you look at this, and just for the audience, free cash flow margin is just kind of another metric to kind of evaluate a company. So if you wanted to calculate what a free cash flow margin is, and free cash flow, for lack of a more extensive definition, is imagine you owned a coffee shop and you start the year with a certain amount in the cash register, and you're not taking money out, putting money in, but you're covering expenses, wages, equipment, upgrades, materials, all that stuff. And at the end of the year, like, what do you have left in the cash register? Do I have more? Okay, then I had positive free cash flow. So free cash flow is basically your cash flow from operations minus any CapEx, capital expenditures. And then you take free cash flow divided by the total revenue. And you would say the higher free cash flow margin companies are much more efficient, and maybe they don't have as much debt. But if lower free cash flow, it's like you can have good earnings growth, but you might not actually be making any cash. So that's kind of the distinction here. But you look at the tech and interactive media. In 1976, it was, I'm eyeballing this, I'll call it, somewhere between 6 and 8%. 1981, it's like 2.5%. This is tech and interactive media. Everything was down. And then recently, everything else has free cash flow margins. I'm eyeballing it, maybe 7%. I don't know if you guys agree with me, but it's tough to do on the scale. And you look at the other, it's probably about 22.5%. So, but it's been growing since the early 90s, late 80s. It's been up and to the right, tech and interactive media. So I see a chart like this, and it almost flies in the face of the idea that, well, these companies are they're gaming their earnings. They're messing with depreciation. They're doing all this stuff. Like, free cash flow is kind of what you have in the register. So I don't know. It's just kind of contrarian, Shane, to what we've been hearing. It's, these companies aren't really making money. They're just doing all these stuff. So, like, free cash flow is really, at the end of the day, what matters. Are you free cash flowing in the business?
Yeah. I think also sometimes I think a lot of people listen to a lot of noise in the market. I'm guilty of it myself, as you very much know. People say things or people talk about potentially doing things, and sometimes it might seem outrageous. Sometimes it does sound outrageous, and it still happens. So I think people sometimes get so caught up in the narrative, and it's hard to believe, or they don't want to believe it. And at the end of the day, a lot of these companies, like you said, in the tech sector, they're strapped with cash. So it's, we're in a very, very large CapEx spending cycle right now. Probably, arguably the largest I think we've ever seen in history, wouldn't you say? And so
maybe, although I look back at the late 90s, and that was another cycle.
Yeah. Yeah, absolutely.
I don't know that their free cash flow margins were as good. Certainly not as good. Not right. According to this.
Right. And falls in line with your argument that this isn't necessarily 2000 because these companies have cash. Some of these high flyers, they're actually making money. They're not just these random internet stocks that people are just buying.
Yeah. Like, Mike, when I look at this, to Shane's point, they do have free cash flow. It doesn't mean they're trading at the right price. Like, the right price is what people are willing to buy and sell at. The right price in 6 months is what people are willing to buy and sell at in 6 months. But I mean, Mike, when you look at these companies, I guess the other thing it implies, and I haven't done any research on this, is, Mike, wouldn't you say that this also implies that the debt burden isn't too high? Because debt service it siphons away free cash flow.
Yeah, that's definitely got to be a component of it. I mean, tech is scalable like no other industry. It costs very little to reach, you make a product for 5 people, really doesn't cost you much more to have that reach 10 people.
No.
So, there's not a huge, of course they're spending money and upgrading and innovating AI, but the costs to do that so far have seemed like very little in comparison to how they're able to scale it.
It's funny because what you mentioned, I guess I can throw my professor hat on for a second. You're describing like high operating leverage, where as the company's revenue increases, because they're not necessarily like their marginal dollar of revenue doesn't cost them that much because a lot of their costs are fixed or they're semi-fixed. it's like as you add the extra dollar of revenue, it flows through the income statement. So these companies a lot of times can be high operating leverage companies. So, all right, there you go. Now you guys can, I won't go into operating leverage, but you can Google that. Mike, are you running for Senate or Congress in the midterms? Are you doing that?
Should I be?
Probably not.
Okay.
Although you will get rich. I mean, it seems like if you go and become a senator, you're there for life and you can go in with nothing and come out rich. Seems like good work if you can get it, right?
I don't know about my public speaking skills. I'd have to work on those, but maybe next round.
All right. Maybe next time. So let's talk about the midterm year. Midterms are coming up, Mike. And S&P 500, this is from, who is this from? LPL Research. And it says from 1950 to, this was on 11/5 of 25, the S&P performance during the presidential cycle. So like year 1, year 2 is the midterm year, year 3 is pre-election year, and year 4 is election year. And the realized volatility is the highest in a midterm year. The average max drawdown is the highest in a midterm year. And the average return is the lowest in a midterm year. So, Mike, are you shorting everything knowing this?
Get out now. No.
No, don't do that.
Don't do that. No, but I mean, it's interesting that that's how this lines up.
Yeah.
It's anytime there's going to be an event that's going to cause some uncertainty, and the midterms certainly do that, you would expect some higher volatility, and the average returns hold true. Now, whether every single time there was a down year, it happened to be a midterm year, if it had anything to do with the midterm year, who knows? I'm sure sometimes it does. Sometimes it may be a coincidence. But yeah, I mean, on average, I guess you can expect more volatility, and but again, not a reason to get out. Or
this is kind of like the sell and make it go away. Like if you're like, oh yeah, I'll short the market because this happens. Like if it's the prevailing opinion, Mike, it's probably not going to happen. Like if it's too easy.
Right. It's too easy. The odds are that you miss out. You got to, time the sell off perfectly, and then you got to figure out when to get back in. And odds are that's not going to be timed perfectly. So, yeah, I mean, it's a stat.
All right, Shane, let me introduce the next thing. And this is from Vertus Investment Partners, Joe Terranova. Sam Rowe had posted this. And it basically says that since 1939, the stock market has produced a positive return from the midterm election date to June 30th of the following year, 100% of the time. And he's got a table in here, and sources Bloomberg. Past performance is not indicative of future results. I'll say that again. But you look at 22, 18, 14, it goes all the way back to 1942. And so I figured out how to read this table. From January 1st to the midterm election date, for example, in 22, it was down 18.61%. But from the midterm date to June 30th of next year, it was plus 17.5. So we were on our pre-call, we were trying to figure out how to read this, and I just figured it out as we're doing it. So you look at this and you say, okay, 02 was a drawdown of 20%. 94 was, by the way, 94 was very, very flat year in the markets. Earnings grew 30%. The market went nowhere. Interesting year, slightly down. 74 was down 23%. And then 70 and 66. Not all years are down, though. You look at 18 was up a couple percent. 14 was up 8.5%. 10 was up 7%. 06 was up 10%. So, but it has never been down, and it doesn't matter. This is different parties, different presidents. If you look at the Senate, sometimes they held it. Sometimes there was a gain. So, Shane, we're always like, what history doesn't repeat itself, but it often rhymes. Like, this is pretty interesting. I guess you don't know if you're going to go down or up between Jan 1 and the midterm. But it feels like from the midterm to June 30th of next year, it's kind of up every time, at least according to this. Who knows?
Yeah, no, I mean, I feel like there's a general sense that like this market's resilient, this market's unstoppable, that it just keeps growing. There's high expectations. And, obviously with votes on the line, like we're going to see most administrations throughout history, I think, be pretty accommodative to voters to try to
Well, if they want to get elected, they'll tell them whatever they want to hear, right?
Right. Isn't that what they do? So,
but Shane, don't you think too, the reason why markets from the election day to, to June 30th, I don't know why I use June 30th. Like the markets don't like uncertainty. And at least once the election's done, Shane, like you have certainty, like markets kind of like that.
Yeah, absolutely. I mean, the whole thing about like vol crushes, I feel like is just vol crush is just a bunch of uncertainty that all of a sudden becomes certain. We realize it's not the end of the world or nearly as bad as expected. It might even be something good happened, right? And then at that point, you see movement higher typically when something like that happens. But yeah, I think I'd buy that argument, and I also think that we've also been up how much over the past couple of years, right? Like with another 15, 20%, 2 years in a row. Like, for averages, like Mike was talking about early, to play out in the long run. I know we run typically 10% roughly in the S&P. I mentioned it on the prediction show. If we were to pull back 5, 10%, that's not that far off of where we are at. And it's also, I don't think it's that shocking if there was a little bit of profit taking and just cooling off before this AI trade continues, more than likely.
All right, Shane, thinking about the markets, remember our audience can't see this. I question whether I was going to let you talk about linear regression channels, and why not? Let's do it. So the S&P, Shane, 10-year weekly chart, you've got a bunch of different lines on here. Our audience can't see, but basically like explain what it is. It really, if I'm a technician and I'm looking at this, what is it you're trying to show here? And for the audience, the market is sort of, there's 4 lines, and the market recently is touching the top line, but not over it. So
yeah, we're in an upward trending rectangle. And when you touch the bottom of the rectangle, you typically see a bounce, as we did in 2020, or the second to bottom level, if you will, like we did in April of last year. But the idea is that when you touch one end, you typically see a retracement back to the other, the middle being the mean. And this is a 10-year outlook. I did one that's also a 5-year. I've got it pulled up on mine. The numbers really aren't that different. The 5 years actually trending a little bit higher up than the 10 years. So it looks like we're seeing more accelerated growth in the past 5 years than we did overall in the past 10. I think that's evident from seeing this. But the reason
so if you're bullish, use the 5-year. If you're bearish, you use the 10-year. That's an old technician's trick. Use the one that tells the story you're trying to tell, right?
Of course, right. You have to paint it ahead of time the way you want it to go. But where I'm getting with this, and the point I'm trying to make, is that the market's done really, really well over the past few years. Last year, barring the April pullback with the tariff fiasco, I mean, what a recovery and what a rally into the end of the year. It wouldn't surprise me if for some reason we wound up flat or down 5 to 10% shortly before, maybe after midterms, depending on how the market digests what it sort of expects to happen with midterms. And again, you mentioned it when I brought up sort of being the only one thinking we pull back this year on the prediction show. And it's something like 6,500, right? It sounds so far below from where we're at, given we're almost at 7,000. It's really not that far. It's not even 10%, right? So I just think that this could be a year where things slow down a little bit. It doesn't necessarily mean it's bad.
Yeah, I mean, this is why we buy, we hedge, we buffer, because who knows? Yeah, look, I mean, if So let me take the bull case. I think we sort of, made the bull case and bear case on the show last week. But if you're taking the bear case, you're saying, okay, from a technical standpoint, and if I want to use a technical analysis that I want to use and show, all right, maybe we've run a little bit too much. And by the way, when you say, Shane, that I don't think we're going to pull back, I totally think it's normal to have pullbacks. I mean, Peter Lynch in 1994 highlighted historical data noting that over the prior 93 years, the market had experienced 50 declines of 10% or more, averaging out to about one correction every 2 years. The question, though, is, and Mike, I don't know how you feel, but would it be unnormal for us to have a 10% correction? I don't think so. It's where you end, though. That's the prediction game you're trying to make. Do you go down and stay, or do you go back up?
Yeah, no, I mean, a 10% correction would be very normal. Like Shane just mentioned, it wouldn't put us back really more than a few months from these levels. So it would be very normal that it happens in markets. They're generally good buying opportunities. The chart looks like it, the technical analysis looks like it would support something like that. But, then where do we go from there? Is it just 10% and done, or does it keep moving lower?
Shane, I will say I love using longer term charts. Like I've even used monthly charts.
I do too. I like looking at long-term trends because those seem to be the ones that really hold. But the other thing too, and I'll mention this just to make one more bull case, I can get it to you later, but if you look at the early 90s, it's kind of a similar setup in that we were trending up for 5-10 years, late 80s, early 90s overall. And then we hit the top of this big long-term trend and we just broke out and ran through the late 90s. And so that's the other thing where it's like, this is held for 10 years, but it absolutely could break out to the upside and a brand new trend form.
Well, Shane, now you're talking my language, the 90s, because you've heard me say this, 94, and
I think that's right around when that breakout happened. If you're looking at that setup from 84 to 94, 94 to 2004.
It's so interesting. So 1994, if you go back, and I think I'm right on this, earnings, EPS grew. So trailing earnings, not the estimates. They grew 30% year over year, but the market went nowhere. And 94 was when they raised rates kind of out of nowhere. And even Greenspan, I still think he just raised them because to remind people that he could do it. And then they cut in 95 and it's just a rocket ship all the way to March of 2000. So I guess 94, what if we have a 1994 where we kind of meander around, maybe we're a little bit positive, but we still get the earnings growth?
Yeah, I was wondering that, Mike or Derek, have you guys been through a market where you have the earnings growth, but the market just doesn't go anywhere? It's almost like the earnings are catching up to the price.
I mean, I just mentioned one I went through, but Mike, how about you?
Right.
Yeah, no, I don't think so, but I think that this would be the market for that to happen in, right? With valuations where they are, you could see earnings continue to go up, but valuations come down and the market could be flat with a big increase in earnings. I think, this would be the setup for that.
Let's look at, by the way, as an investor, building up, earnings still growing. To me, earnings is still the most important part because the market will trade higher valuation, lower valuation, but it still comes back to earnings. And at some point it picks a multiple and it does it off the earnings, and it does it off the earnings growth, the forward. So to me, if the market falls, but earnings are good, I love that. And it means the market in theory gets cheaper along the way.
Right.
So, all right, here's kind of an important thing, though. I look at the Philadelphia Stock Exchange, the Semiconductor Index, or known as the SOX, the SOX, And I looked at their earnings per share analyst estimates over the next forward 12 months. I mean, they're expecting 36.75% growth in EPS. And then you look at the sales per share, that's expected to grow 15.8%. That's like 28, 29% net profit margins. You look at cash flow per share, growth of 39.94%. Like, okay, so you could argue this market's a little bit priced for perfection, but thinking about the semis and, are we in the fourth inning of AI or the seventh inning? I guess we'll know when we know, but like these analyst expectations and what's in here, it's NVIDIA, it's AMD, it's Intel, it's like all the companies that you would think would be in this. So, and I guess if you're a bear, you're saying, no, this isn't actually going to come to fruition. Like this is not going to work out. These companies are not going to grow that much. There's going to be margin compression or CapEx spending will go down and all this goes down. But
yeah, that's worst case scenario is that
sure
the earnings aren't met. If these earnings are met, you could see the PE actually come down and the stocks still be higher.
Like or go up. You could see the PE go up.
But yeah, I'm just stating that the valuations come down and this thing could still be up because of the earnings. Like
right, it's a relative thing.
30 PE. If they hit their earnings, the stocks is still higher than it is today.
But if they miss, this is window dressing here. I mean, maybe that's not the right term to describe it, but like if this misses at any point, like that causes problems, right? I mean, you would think, or do you think?
Yeah, no. I mean,
are we seeing a rotation in the broader market? Do you think that this just gets taken out of this and put elsewhere? I mean, I don't know.
Well, I mean, yeah, I mean, I guess sometimes you have to decide, do I want to argue the bull case or the bear case? And I guess I'm kind of doing both here. At 27.20 forward 12-month, it's a forward PE ratio. So trading just over 27 times forward estimates. Yeah, like what if the earnings come in more, but the forward PE drops? Like that's something right. Analysts tend to, but to your point, Shane, like if they miss on this, let's say they don't get 36% earnings growth, they only get 20. Yeah, these and it's always the future. So then what's the next 12 months? But yeah, if you're trying to make a bear case, you're saying this market is very levered to a lot of this tech stuff. So
I also, I don't get how you want to bet against the area that it seems like everybody's investing in though, right? I mean, you're sort of fighting the flow, aren't you?
Yeah. And these can go on, this investment cycle can go on longer than people think.
Right.
And remember, it doesn't have to mean that the AI, again, ChatGPT is not public, but who knows what that company will do. It reminds me of Netscape and Excite, Spyglass. You guys probably don't even know what those companies were, but they were all like and they all traded at nosebleed valuations and no earnings. And they all sort of went away. They either got absorbed or they went away. But the internet technology accreted to all the companies. And I guess that's what we're thinking with AI. If it comes down and helps productivity and all that stuff. All right, let's move on from this. It doesn't look like we're getting a ruling on the tariffs today. So there was rumored that the Supreme Court would come up with a ruling. This is a chart from Bloomberg. Polymarket sees a 25% chance of tariffs. In favor of tariffs being upheld. So basically a 75% probability or chance based upon Polymarket. So Mike, to me, if I'm trying to look at what the market's doing versus we have this ruling coming out, to me, there's a chance, this is my prediction, okay? It doesn't really mean anything. I think they overturn this on the narrow rule of the reasoning of why the Trump administration did it. But I think there's like 4 other ways that they just continue these tariffs? And my guess is the Supreme Court, they say no, but they basically say in their opinion, if it was one of these reasons, and not so many words, and they don't take away the tariffs, like there's no refunds. Mike, you have an opinion on this? Like, but I like the market's not acting like this is a problem, even if they say no.
Yeah, I mean, I was going to say the market knows this is going on, right? So it seems completely unfazed by Polymarket seeing a 25% chance of this being upheld, which means either the tariffs aren't a big deal and they could go away. I don't think that that's the case, or that there's other avenues to get this across the finish line. So I think that that's what the market's pricing in here, is that if it is ruled against, if tariffs are ruled against, that there's other avenues to get this done. Otherwise, I think we'd be seeing a lot more volatility if there was uncertainty around whether these were going to be upheld or not.
Don't you think too that, say this was overruled and there is no like second plan that works, right? Say this doesn't work and there's some clawback that's required or anything of that nature. I mean, that money's going to corporations more than likely, right? So that's putting more money into companies that are in the market, and that's at the expense of money being taken back from the U.S. government. So that's not good for the dollar necessarily. So at that point, wouldn't that potentially drive assets higher? I mean, I don't think there's really a bearish case to make necessarily in either direction here. It just doesn't.
Well, I don't think the tariffs. I mean, it seems like the exporters and importers, and Scott Besson and had done an interview on this, but I think there's been some research that said basically they've been absorbed by exporters and importers. To your point though, Shane, like if you're the market, I say the proverbial market, and you say if the tariffs go away, net profit margins go up because all these prices are still going to stick. The market, in theory, if you believe that, should be higher. And I think what the market is pricing in, Shane, and maybe you're saying the same thing, is they're not going away. They're not getting rebated. And as soon as they get ruled against, they're just going to say, yep, this is the other reason.
Right. I mean, if that money is rebated, it's somehow going to make its way back into the market anyway. So I think it's almost just looking at this as a wash at this point.
I mean, so far it hasn't caused inflation.
San Francisco Federal Reserve published in an article back in late November of 2025. They think that tariffs, if anything, might be deflationary because it might curb some demand. It also, at the same time, brings money in. You have a Fed bank making the argument that, hey, a lot of these people were actually wrong on the effect that this was going to have on the overall economy. So we'll see how it shakes out.
At some point, do they send out the checks? So it's estimated roughly 260 million people in the U.S., adults 18 or over. So if they wanted to send everybody $1,000, how much money is that?
Are we really still counting at this point? I mean, doesn't this go back to the I'll give you.
No, but I'm saying is it one?
Yeah.
If we raise 2.6 million in tariff revenue, and you want to send that to everybody, what is that a person, right?
You said 2.6 billion?
No, 2.6 trillion.
Trillion, sorry. Yeah, with a T.
Yeah. So think about it. I mean, how much, what I'm trying to get to is if you raise 2.6 trillion and you say there's 260 million adults, and I am arbitrarily coming up with this.
That's $10,000 a person, roughly.
Is it 10? Okay.
That's what I got. Just marginally. Again, that's off the top of the head. But yeah, I see your point. I also think that, we get back into the AI argument. If and when more people become displaced, like, are we going to be that surprised to see some form of more rebates, more checks from the government, things of that nature?
Oh, I'm not even saying that. But at what point do they just say this is a dividend? Like, people are going to be like, oh yeah, tariffs are pretty cool.
You think it's
I'm not saying they are or aren't, but
you think it comes in form of tax write-off this April, maybe?
Would it be a check or a tax write-off?
I could see them letting you use it as a tax write-off instead of a check. Mike, what do you think?
I like that idea of tax write-offs or just lower tax rates.
I don't know. I could see it being easier instead of sending out a check and dealing with that process of that, just mandating that when you file your taxes, you get an additional 1,000 to 2,000 off, given what you report.
I think your math is off, Shane. I think you need 2.6 trillion to come in there. All right, we'll check that in a little bit. Shane, congratulations to Alphabet. They did it. They passed Apple. Thoughts? Market cap. Explain what this is.
So pretty historic, right? I think for the first time ever, Alphabet is just overall based on the total number of shares that exist relative to the price that it's trading at. That being multiplied out gives you the market cap. Market cap is currently greater than Apple's. It looks like it's 3.9 something trillion. It's being blocked. That's a 2 or a 3, I think. Relative to Apple's 3.79 trillion. So the only thing above Alphabet now is NVIDIA. We'll see how that plays out. But, there's the arguments for the AI, who's going to win that race. I mean, Google seems to be the preferred choice of like who's benefiting most from AI outside of probably NVIDIA. It seems like so.
Yeah, the narrative on Google has flipped. I mean, they were trailing sort of the first half of the year, this AI race, and the last sort of, I don't know if you want to call it quarter and a half of the year, the narrative flipped, and you saw Google really start to take off.
Super intelligence. It's a race to whoever can develop the smartest, fastest thing. And I mean, I wouldn't see why Google doesn't have the capability to potentially win that. I also think that the market's happy with what it's seeing from Google with the AI within that space, more so than it is Apple. I mean, I don't know about you guys, but I don't really see much AI with Apple going on.
You guys have iPhones, right? Siri is unusable.
It's awful. It's terrible.
Like, seriously, Siri, can they just make it so if I ask it something, it like I asked it something the other day just to show somebody how bad it was, and it brought me to a website that didn't even make sense.
Right.
Like I sit in my car, I'm like, Siri, open the map app and do driving directions with turn-by-turn navigation to, some doctor's office I was going to. And I couldn't do it. Could not do it. I'm like, it's useless.
Yeah, you prompt it the way you prompt an LLM like ChatGPT, and it can't hang. So,
useless.
Yeah.
All right. By the way, I was curious about this. So according to a internet search, which is worth nothing, in fiscal year 2025, ending September 30th, U.S. tariff collections surged under President Trump's renewed policies, reaching approximately $195 billion to over $260 billion. So, all right, what do you need? Like $216 billion. So to get $1,000 per U.S. adult, you need like $260 billion, right? So we're almost there. I mean, you'd have to give up all that revenue and not retire the debt from it or put it towards other things. But I'm just saying, if they want to send it out in a check, you get inflation from it.
Yeah.
So, all right, let's move on. 3-month payrolls. We already talked about this. Non-farm payrolls was what? Minus 22. Is that in minus 22,000? That's a simple moving average over 3 months. So 3 month simple moving average minus 22. I mean, we've had since kind of April of 25, we've had some months slightly positive, some months that were lower, negative. This one was what, 50,000 was the change. So I guess, Shane, the thing I really want to know, I'd want to see this broken out by private industry jobs and government jobs. Because I'll bet you private industry is more steady. And it's really been some of the stuff that either through Doge or some of the other things they've been doing to reduce the size of the government workforce. So,
I think this is one that calls for needing to see a more micro look at this data. All
right, so do that tonight, Shane, Friday night.
That's my homework, Friday night. I got it.
You're going to find that out. And the average square foot, the median average square foot price of a house. Mike, I know you're an expert in all things copper futures. I'm kidding. You do not trade copper futures. So, all right, this is a chart of copper futures. They made a new all-time high after sort of going, they were down at the low end. I superimposed a chart of FXI, which is the China ETF. Normally, how goes copper goes China. It's not really the case this time. It seems like it's a supply-demand thing. There's been, if you do a little bit of research, seems like people have been hoarding copper because of the tariffs. But Mike, to me, what do you use? I feel like you use copper in some of the data center stuff. You use there may be some tech applications here. Like, is this a good sign for the economy? I'm totally hitting you out of the blue with this. You can just tell me, I don't know.
Well, I don't know, but if I had to take a stab at this,
take a guess.
Yeah, I think it signals some sort of expansion here. I don't know, how it correlates exactly with China's market. It looks like it's, like you said, traded pretty much in lockstep up until, I don't know, the last few months, where it's
since July, really.
Yeah, they've crossed. Now, this is just general copper prices, right? So this is including buyers around the world that are.
This is the copper futures price.
Yeah,
this is just a continuous commodity. Yeah,
I know data centers are a big thing right now and being built all over the place. So I'm sure it signals some sort of expansion there. Why China's lagging? Well, like you said, I think it's more of a supply demand thing here that's driving copper versus the Chinese market.
All right. All right. That's it. Let's go to recommendations. Mike, any sporting events that you want to recommend that the audience will have already missed by the time they listen to this? Or do you have
many? Yeah.
Okay.
Yeah, there's many. So hopefully my teams win this weekend. Got Indiana tonight and the Bears tomorrow. But for shows, so I finished The Beast in Me. And I highly recommend that one. It's on
strong buy, or is it on your conviction list?
It's a strong buy for me. Yeah.
Okay. You taking a break after watching that? You need a little time before you delve into something else?
Yeah, I think I got to figure out what the next watch is going to be.
Okay. No, The Beast in Me. We talked about that. I put it on my list. I haven't watched it yet, so. But I'll take the buy recommendation, probably check that out. Are all the episodes out, though?
Yes, they're all out, so you don't have to worry about that. Oh, if you like reality TV, a new season of Traders just came out. The show's pretty entertaining.
Traders? What is this about?
It's on Peacock. So it's a group of like 20 C-list celebrities, and 3 of them are traders. The rest of the contestants are what they call faithfuls. And the idea of the show is to figure out, through games and interactions, who the traders are. Every week they vote someone out, and you're trying to vote out the traders. But the traders,
I feel like you're going to watch this for one season and then you're not going to be back for another season.
I've watched 2 of them.
Okay. All right. So The Beast in Me, is that right?
Yes.
All right. So that's Shane. How about you? What do you have?
I was just going to say, I think that sounds like is that the werewolf game that was invented way
exactly.
years back? Yeah,
Just like that.
okay. Nice. Okay, that's fun. Show wise, we started Arrested Development. It's a little raunchier, but I tried to watch it when I was younger. I just couldn't get into it. And after having gone back, I like Seinfeld, like shows like that. I did Cheers. It's a good show. I like Jason Bateman, and he does it well. It's we just made it through the first season, but it's a little raunchy. It's pretty funny though.
I love that his son, the name they go with in the show is George Michael.
George Michael,
of course, was a singer.
Yes, and I looked at, so my wife has seen it already, and she insisted we had to do it. And I looked at her, and I was like, "There's got to be a George Michael's joke coming, And of course there was, and I think there's been multiple. But yeah, that's great. I mean,
so I'm glad it translates, because the one thing I wonder is some of the pop culture references. I wonder if those translated as well if you're watching it fresh today. But I mean, there were some really good people in that. Show.
Yeah, the list of like special guests on here, they have some pretty awesome like sort of subs. Like Carl Weathers appears, in season 1 randomly to assist for a couple of episodes. So I like it. It's been funny so far.
Like Charlize Theron. When she was she's still a big movie star, but probably, even bigger movie star. She was on the show. I don't remember how many episodes.
Liza Minnelli is in it. And the only reason why, because I think, so my wife was saying when it first came out, people were like, why is Liza Minnelli doing this show? And she, I guess, like babysat one of the producers when he was growing up. And, essentially was just like, oh yeah, I'll do your show, help him get it off the ground. And she's hilarious in it. So yeah, I'm surprised and happy. I mean, you've got, what is it? The guy who plays, Better Call Saul's in it.
Yep.
Henry Winkler, you got Jeffrey Tambor. It's got a bunch of awesome actors in it, actresses.
Yeah. It's funny too, because that got canceled and everyone was like, why did that get canceled? It used to be on Fox.
All the things. Why is that?
Yeah. All right, I'll support that recommendation to the audience. I actually don't have a recommendation. I almost was going to watch the second season of The Pitt. It just came out. But come on, HBO Max. Why are you only giving me one episode a week? So I looked. It's 15 episodes. Their last episode is April 26th. So I'm not watching it until all the episodes are out. I'm sorry. Just do it like Netflix. Give me all the episodes, and I'll decide when I watch. So
how did you survive in the 90s?
Yeah, like what was The Sopranos like, or like Lost, or if you did any of those, like would you have to tell people to not talk at the water cooler or like at your desk?
No. Back then you had to watch them.
Yeah, if you didn't.
Netflix has spoiled me. It really has. Yeah, like Lost. Oh, God, I love Lost. That was a great show.
That was the first like epic TV drama I think my parents let me watch, and that was one of the best.
But I just want to explain something to you. So this show means nothing, but when I say this, but the Who Shot JR episode. So it was a show called Dallas, probably late 70s, early 80s, and one of the biggest episodes ever was Who Shot JR. J.R. Ewing was the character, and he gets shot, and that's the cliffhanger. But think about it. There's no DVR. I'm trying to remember if we had VHS, the ability to VHS record back then. I don't remember. I was a kid. But it was kind of like, if you missed that episode, you had to wait until reruns, the end of the summer, to see it.
Yeah, this aired in March of 1980, so you had to wait till August. That's unbearable.
There's no VHS back then, so think about that. And you get a phone call, and by the way, you had house phone, but you get a phone call, like somebody unplugs the TV, like, no, it's done. And there's no YouTube, there's no like looking it up. Oh, I'll just catch this online, I'll stream it. Nothing. You literally didn't get, because they would rerun in the summer all the episodes. And then you'd see like the cliffhanger, like right before the new season.
But then you got to make that one. If you miss the rerun, then you miss the rerun. Like, You didn't have much. I mean, what you had a
No.
TV guide, right, to know when something was coming on.
Well, the newspaper or the TV guide, but you had no idea really, like maybe a month at a time. If you looked at the TV guide or the newspaper, you'd figure out when the episode was. But now it's
Yeah, we need to go back to that. I like it. Make it anxiety inducing. Like, give something to look. I don't know. I remember TiVo coming out, and it was just world changing, revolutionary. When you could pop.
The final MASH episode. Let me see. Final MASH air date. And then we'll get going here. Now I got to see. Yeah, so February 28th, 1983. The final episode of MASH was a 2.5-hour episode. It was on CBS. And MASH had been on for years. But I think that's the highest rated episode of a show of all time. But there was, I don't remember if maybe we had VHS in 83. I don't remember. But like if you missed it, that was it. Like that's when you watched it. Same thing with like, imagine watching a football game now and you're like, oh, let me pause it to go like, grab something to eat and you come back. No pausing. You missed it. So, all right, let's get out of here. Are we done? We solved all the problems of the world in finance here?
We did. Till next time.
Right. All right, everyone. Thanks for tuning in. Derek.moore@zegainvestments.com. That's DEREK.MOORE at C as in zebra, E as in Eddie, G as in George, A as in Apple. Investments is up to you to get correctly. Spell correctly. If you can't do that, you can't reach me over email. It's been a while since we did a listener question segment, so send your questions. All right, guys. Hope your teams won this weekend, and we'll talk to everyone next week. See ya.